At a high level, when you're in retirement, a lot of people don't know this, even if you have income actively coming in from a pension or even Social Security, it can be tax-free as long as it's under a given level each year. And so there's a right and a wrong amount of money to have in any given type of account, whether that's an IRA or 401k, a non-retirement account that will tax you based on capital gains and dividends and interest. And then when you go past that, we look for tax-free sourcing of income. Examples of that would be Roth IRAs or 401ks. And on that point, a lot of people earn enough income each year where they're above the IRS maximum to directly fund a Roth. There are still ways to get money into a Roth. Backdoor Roth contributions, Roth conversions, which can have a lot of pros and cons and complexities. And then there are actually certain types of life insurance products that you can put cash into, allow to accumulate, and withdraw principal and growth on the back end on a tax-free basis. So there's no one person situation that looks exactly like another. It's super, not complicated, but time-consuming to understand based on where we are and based on all these other factors that a person has. How should you shift that balance sheet around to make sure they have the right amount of income in retirement coming from each source? In some cases, you don't have control of it. A pension, which is becoming less common today, you essentially have to get it and you have to pay tax on the income. It's a great benefit, but from a tax perspective, it can make things very difficult. Social Security is set up the same way in that it's forced to be distributed once you turn it on and you can't turn it off. And depending on how much taxable income you have in addition to that, you may pay zero tax on Social Security income, or you may pay income tax on 85% of that Social Security income. There is required distributions around pre-tax accounts or IRAs and 401ks. So right now at age 72, the IRS says whether or not you want that income, you have to start taking income at age 72. It's normally about 3.75% of your account balance. And then each year from then forward, that 3.75% goes up a little bit each year until you're gone. And so it can become an issue. Roth IRAs and the insurance, tax-free insurance tool that I mentioned don't carry required distributions. So depending on someone's situation, if you don't need income, that's a place that you can leave money be. It also creates some efficiency when people leave money onto their heirs or charities and things like that. We help people with this tax mitigation process, as we call it. Some of them are in their 40s and some of them are in their 60s or 70s. It's different for each one. And candidly, some have more pain involved than others, but there's no one size fits all. It's all customized to where are they at, what's most important to them, and what other things do they have feeding into their situation that maybe we can create offsets or other things to lessen the pain in the process.